Hello, welcome. It is I, Frank Array, here with my good friend Barry Habib, and we just wanted to have a conversation of sorts with you guys. And because it's always a pleasure to have you as a guest on whatever podcast I'm doing, Barry, thank you for doing this. I appreciate it.
Frank, it is so good to be with you always. I enjoy it, my dear longtime friend.
Indeed, man. Indeed. Yeah. So let's get caught up on some stuff that the loan officer community can glean some insight from, right? Get some enjoyment out of because you always bring it, Barry. You just always bring it, right? So hey, let's go ahead and start with the obvious place. I think that most originators, when the Barry's on, first thing that goes through their head is rate, market, that kind of thing. The Fed, what's happening. We're recording this the day before a Fed meeting, right? So you'll be seeing this, guys, or hearing it after that. But give us your thoughts on rates, the Fed, that kind of thing going forward here. We are in the end of 2025, October of 2025 for reference, for those that are listening or watching.
So, a lot of good things, I think, ahead for loan originators. I think there's reason to believe that after some challenging times, we're finally going to have a tailwind.
Mm,
So, it seems like we've been climbing uphill. Just to give you an example of a couple of stats here, from 400,000 originators, we're at about 175,000. So,
really?
yeah, so, congratulations, you guys have survived, but you're about to be rewarded for your tenacity and for your ability to withstand a little bit of this, more challenging period of time. So, why do we think that some good times are ahead?
Yeah.
Well, interestingly enough, going through those difficult times, you planted a lot of seeds, right? So
Mm,
3 years plus worth of seeds planted, meaning you've got loans that are refi eligible. ICE, the data company, they tell us that if we hit about 6%, it unlocks about 5 million loans, and that's qualified by saving 0.75%
wow.
in rate, at least in 80 LTV, and a 720 FICO. So really eligible transactions. So
Yeah.
to put it into perspective, in the entire year of 2024, we did about 1.2, 1.3 million refinances. So
Okay. That's
this could
huge.
be huge.
Yeah.
Now, why will rates come down? Well, this will be after the Fed meeting. The Fed will have cut a quarter. I'll say that we know that that's going to happen.
Mm,
But an important thing for us to hope for is that will they have said they're going to stop the runoff of their balance sheet? They've stopped it at different levels in the past, or they've reduced it. Each time it's helped interest rates, it's helped mortgage-backed security and 10-year treasury pricing. So that's good. And another thing people get confused upon is they say, oh, well, the Fed cuts rates and then sometimes mortgage rates go up. Look, the Fed cutting rates helps mortgage rates go down. What we have to understand is that the market is forward looking. So the market often comes down in yield before the Fed's cut rates. And then it depends on what the news is afterwards. If we
mm,
get strong economic news, well, rates could go up after that. So
mm.
there's a lot of factors at play, but in the vast majority of cases, Fed cuts help us. So why would the Fed want to cut rates? They're predominantly focused on the labor market. And fact of it is, it's definitely weaker. It's definitely softer. We all know about AI. AI is reducing jobs. You
Yeah.
just heard from Microsoft, from Amazon. A lot of cuts because of replacements by AI. That's not going away. And for mortgage professionals, you know, we have to be careful too. You know, you probably use AI a lot. I use it
Sure.
so
All
much.
the time.
You forget you're talking to a bot, and
Mm.
you'll be like, "Oh, wow, thank you so much. That was really
I know.
nice." Yeah.
I say
Um,
thanks all the time to AI. Thank you. Appreciate that. Sorry, my
right.
bad. I meant this. Yeah.
Yeah. I mean, obviously it shows you and have good manners, but what it
Mm.
also does is it shows that we can also be lulled into thinking we're talking to a real person.
Yeah. Right.
And in the past, all of the stuff with technology where people said, "Oh, our loan officers are going to be replaced." Well, that tech was like a one-way street. It goes upstream, but it doesn't really give you that feedback that you can converse with. But now you can. So
Mm.
it gives you the illusion of talking to somebody. We're fortunate that you need a license to quote rates and fees. Now, I don't know if that changes in the future.
Yeah.
But we need to be prepared to differentiate ourselves. So what we have to do is we just got to get sharper. Putting a loan together and guidelines, AI is going to kick our butt.
Yeah.
But what we really need to do is do things AI really can't do. And that's kind of like advising into the future, knowing market conditions, what's going to drive stuff. So,
Mm.
so these are really important ways for LOs to sharpen their skills and make sure that they preserve themselves. So back to your question. So inflation is coming down. Inflation is overstated, Frank. We've talked about this in the past. It's 2.9% on core personal consumption expenditures. The Fed looks at that, but it's really 2% because tariffs is a one-time deal. You got to look past that. That's about three-tenths worth. And then there's the silliness of this owner's equivalent rent, which is just a survey question asking people who really don't know for sure what they could rent their home for. Now, it
Yeah.
tends to come down over time, but it lags. And it's starting to help. The last report we got on October 24th showed, hey, at least for that month, we're coming more in realities terms. So
Mm.
we think over the next 12 months that helps us. That's probably overstated by another three-tenths. And then there's something that people don't know about very often. It's called portfolio management fees. So if you have money in a mutual fund, or if you have a broker dealer that's holding your account, they're going to charge you on your assets. That's typically the way it works. It's not so
Mm.
much transaction based, it's more asset based.
Mm.
Look, if it's 1% that they charge you, and if they rose it to 2%, well, clearly that's inflationary. But if they keep it at 1%, however, if you're paying them more because your assets are growing, well, that's a
Mm.
1% you don't mind paying. But the BLS considers that inflation. That's really a silly way to look at it.
Interesting. Yeah.
Think about this, Frank. Imagine if there were real inflation in the grocery store and you just go to the grocery store and say, oh my gosh, I am paying so much money. This is terrible. Inflation is really out of control. Then you go home, you open the mail, and you look at your bank statement. And in this case, let's say stock values were coming down, down, down. And now when you look at it, you say, goodness gracious, now I'm really sick because I see my portfolio is dropping. But the Fed will say, wait a minute, there's no inflation out there because your portfolio management fees are coming down to offset the inflation at the
Mm.
at the supermarket. So you can see how foolish it is to look at it, and that accounts for about three-tenths. So I think inflation's really at 2 and
Mm.
not 2.9. That's a tailwind for us. It means over time things will correct and come
Mm.
down. Fed members hopefully will see this. As inflation comes down, it helps rates. Labor market's weak. We get Fed rate cuts. The runoff of the balance sheet, if they slow that down or stop that, which I think might happen. Look for that announcement. Hopefully, by the time you're listening to this, we will have gotten that. That's good for us. So, look, I think that there's great news ahead, and that will help the real estate market because
Mm.
if we get lower mortgage rates, the other thing is the spread between the 10-year Treasury and mortgage rates. That's been coming down. Look, I think it's possible, really clearly, that we get under six, maybe as low as five and three quarters, maybe
Okay.
five and a half. Bro, that's a great market for us. I
Are
think we
you
can
are you
really.
thinking that's like mid 2026, late 2026?
I think sooner than later. I think within the
Really?
first 6 months. Yeah, because look, let's face it, the runoff will happen soon. The rate cuts will happen soon. Inflation is starting to come down. The labor market is showing signs of weakness. So all of these things could benefit us in the shorter term. And as these things start to happen, the spreads start to come down. There's another couple of things, just regulatory stuff that's happening. One is the passage of the Genius Act, which
Mhm.
allows for stable coins to be more in use. Will then see a stable coin means we're just moving towards a more digital currency, right? And
Mm.
everybody wants that. So with more digital currency, it has to be backed by something concrete. What would
Yeah.
that short-term treasuries. So as more stable coins grow, and it will, that means that you're going to need more short-term treasuries to be absorbed because you have to buy the short-term treasuries to back it. That's good news for us because as we have a lot of debt, as treasuries are issued, we would now be able to issue more short-term treasuries and have the absorption, less 10-year treasuries. That preserves the value, preserves interest rates. Maybe interest rates can come down based upon that. And then what'll happen, Frank, is that you could see that helping us. The other one regulatorily is the bank deregulation deal. Scott Bessen's been really big on this. If banks can now be able to buy treasuries without having to take a hit to their capital, well, that means that they can do this, make money on it, and still have enough capital preserved so that they could use that capital towards making other purchases or other loans. That means more treasuries get purchased. Scott Besson thinks this could be like 30, 40 basis points on the 10-year. Now, all those things tell me that in the next 6 months, we probably could be in for some improvement in rates in a meaningful way that'll help volume levels pretty significantly.
Golly, that is a lot. And that is fascinating information. And that is really, really good to hear. You were saying that what it's ICE was saying that if rates even just get to six, that opens up almost, like around 5 million opportunities as far as refinances go. And then you're saying that, gosh, maybe we even see sub six, coming into the beginning of the year, something like that, the middle of the year, sub six. Man, I wonder how much opportunity that would open up as well.
It's a big opportunity. You're 100% right. And here's a couple of reasons why. Now, the media often gets this wrong. They say, okay, well, we see rates drop, but mortgage applications didn't pop up. I mean, what do you think happens? Rates come down a little bit, and people say, let me put in a mortgage application
Right.
today for a purchase. No, on a refinance, maybe.
Yeah.
But on a purchase, it's a different story. First, awareness. Oh, I didn't know rates were lower. Oh, that's good. Two, maybe we should start looking. Where should
Mm,
we start? Let's call a
mm,
real estate agent. Let's
mm.
go out 2 Saturdays from now. It takes time. Then shopping, maybe a few weekends. Then, oh, I like this home. Let's put in an offer. If it gets accepted, let's go to review process. Let's do the inspection.
Yeah.
And then I'll pay money for a mortgage app. So we have to have some sustainability in rates that have improved. I think we get that. And then at that point, you'll start to see mortgage apps on purchases come up. There has been a lot of pent-up demand. We've been averaging about 1.8 million household formations per year.
Hmm.
That has really dropped to about 1.2. So what did builders do? They were smart. They said, look, we're going to reduce the amount of homes we're building down to 1.2, which they have. They've right-sized it.
Hmm.
But the thing is that if rates drop and all of a sudden activity and purchases start to increase, well, builders can't keep up with that right away. It takes time to go
Right.
through the process of building. And here's the opportunity you mentioned is that if you have more demand rise quicker than supply could keep up, there is a period of time where you will have more appreciation or growth.
Mm.
So it's a money-making opportunity to make those purchases.
Awesome stuff, Barry. Thank you. Hey, can we shift gears real quick?
Yeah.
You're over with Fannie Mae now.
Yeah.
You're on the board over there. Uh, I remember when I saw that announced, and I thought to myself, I got to talk to you about that because I'm just wildly curious about what that really means and how you really contribute over there, and what's the experience like, and just basically all of it. Like, how did you get the gig and why, and then what are you doing for them? And can you just fill us in on what's going on with your role over there and what's transpiring?
Yeah, so it's been wonderful. It's absolutely been a tremendous honor. It's a humbling experience.
Sure.
I'm so grateful for the opportunity. Before we completely shift gear, just one
Oh,
thing. Look,
sure,
we
sure.
do
Sorry
think
about that. Yeah.
no, no, we do think rates come down, but look, if a news item comes out, if something
Right.
happens, look, that's going to take precedence, right? So while we think this is going to happen, there's never a guarantee. Back to
Yeah.
the Fannie thing.
Yeah.
So, Director Pulte, who I think is a great director, I've gotten a chance to get to know him a little bit. He wants to do good and he wants to get stuff done, and he's a no nonsense kind of guy. But because Fannie and Freddie are in conservatorship, it's a weird situation because a lot of stuff gets political, a lot of stuff, and we know the political environment. It isn't like there's a lot of consensus on both sides to get things done, right? Even if it makes sense, it's difficult time.
Right.
So it's not easy, but Director Pulte is really trying to do good. He wants to tackle issues that help homeowners, that help potential home buyers, the housing market, that are really good for us. So when when I heard from Director Pulte that he was curious if I would be willing to be a director, I was obviously very, very humbled and grateful. And back in July, he called me up. He says, "Okay, are you still interested? Do you still want?" I said, "I would love to." "Okay, I'm appointing you." And that was a big thrill for me.
Wow.
Now, I wanted to do good, so I said, "What can I do that helps our industry, that helps the country, that helps people?" And because I hear from you guys all the time, and as you do, Frank, you have your finger on the pulse as well. One of the themes that kept coming up was, boy, these LLPAs are difficult because since they've gone up in the last couple of years, it's created more private label type of loans, which lenders don't want to do it. It's not, it gives them a lot of heartburn. There's a lot of reps and warranties. They'd rather just sell to like Fannie. So what can we do to facilitate that? And I thought, well, maybe if we reduce some of the LLPAs and then made up for it in the additional business, that might really help. However, the problem is that we're at Fannie and Freddie, we're required to have minimum margin requirements that are set, you know, by essentially by law. So it's difficult for changes to be made since we're in conservatorship. So we have to get kind of creative in ways that keep the minimum margin, but maybe add some relief and hopefully bring on some business. So I thought maybe if we could do a targeted approach, and that approach would be to focus on things more like, for example, maybe it's the cash out refis, and not everywhere, but specific areas, and maybe some relief on second homes
Mm.
and in areas where like non-owner occupied. That's where I'm hearing that the LLPAs are so onerous that, I mean, think about this, Frank. If you have a 300 basis point LLPA, for example, on a cash out
Mm.
refi, somebody
Ridiculous.
could really benefit from a cash out refi
Right.
because they can now reduce their debts, they could free up some capital, they can make investments, they could do things that really help them. But boy, oh boy, could you imagine telling them that it's going to be, $30,000 in closing costs? That's a bit of an obstacle,
Yeah.
right? Because, if it's a $500,000 loan, you got 1,500 in LLP, 15,000 in LLPA, and then maybe all the other closing costs. I don't know, maybe it's 20 or 25,000. I don't know,
Sure.
but
Yeah. Right.
it's certainly an obstacle.
Right.
So if we could have some relief there. So I've been trying to focus on that. Director Pulte's been very kind, and he's made public that he knows I've been sending him some ideas, and I made a proposal, and he wants to really do good. It's just that he has to kind of be able to go through the different the different steps
Yeah,
necessary.
the layers of
Yeah. So look, we've got the right guy there. I mean, there's
yeah.
nobody better than him to
Yeah.
get stuff done.
Yeah.
So I know he wants to, and I'm hopeful that maybe some relief can happen on the LLPAs. It's a priority, I think, for the industry. It's a priority for him, and it's one of the things I'm hoping to be able to have accomplished.
Hey, uh, and forgive me if I'm ignorant in this, but um, the whole matter of Fannie Freddie, this IPO they're talking about and whatnot. Are you as a director, are you involved in those conversations? And do you have any insight to any of that?
Well, the only thing I know is just what's been publicly tweeted by the
Okay.
president, what's been publicly tweeted by Director Pulte. So, I know as much as everyone else does
Okay.
as far as what's concrete. There's a lot of discussion about it,
Mm. What are your
but
thoughts
who
on it?
knows where?
Yeah,
Yeah,
what are your thoughts? Just as Barry, just kind of what are your
as
thoughts?
Barry, I think it would be a good thing. I
Mm.
really do, because then there would be more freedom for Fannie and Freddie to do things
Mm.
like these adjustments,
Sure.
without having the additional layers, as you
Mm.
correctly said, that you'd have to go through. So more flexibility to be nimble
Neat.
and
Yeah.
to be effective. So I
Okay.
think it would be a good thing.
All right, cool, cool. Hey, let's wrap this up with just some thoughts, some advice for the originator going forward, through the end of the year and at the beginning of the year.
Well, this is a really important time for an originator. So I think there's going to be a big opportunity. You don't want to miss it because, and I'm not saying you'd miss it entirely. Sure, volume would go up. You're going to see your volume go up. So that's
Sure.
going to happen. You almost can't help that. But what can you be doing now to cast a much bigger net? I know that you help people all the time and giving them advice every single morning, better than anyone, as far as what they could be doing in order to help themselves be better. So I think you should be contacting your customers now, establishing a rate that it makes sense for them to refinance based on a dollar savings. We call that a strike rate at MBS Highway. Also look at MI opportunities because we've had appreciation. So you'd
Mm.
be surprised. You may combine that with a reduction from a 95 to an 85 or an 80 in LTV and reduce or remove MI, a 90 to an 80, remove MI. Combine that with the savings that you have in interest rate, and it becomes very attractive. And remember that these opportunities, when they haven't happened in the past, they've been short-lived in many cases. Let's hope that this lasts, but there's no guarantee. So prepare now. And when you see that opportunity occur, have it already established with your customers so that you can be doing this. And look, remember with your real estate agents, explain the opportunity that exists by more demand, supply not keeping up, great opportunity. Remember, marry the home, date the rate. That has worked fantastic in the past 2.5 years. Values have gone up on average across the US on a $500,000 home, $60,000 because that's 12%, which has gone up in the last 2.5 years. So if you get something like that and the opportunity to refinance, the appreciation more than outweighs the cost to refi and the
Sure.
small amount to pay monthly. So all of these things should be happening now so that you hit a home run as rates continue to drop.
Wonderful stuff. Thank you, Barry. Always a
Oh,
pleasure to
bro,
chat with you and
always good to be with you.
learn from you and that kind of stuff. Of course, go to mbshighway.com if you're not already there. I think you pretty much have every originator on the planet over
Well,
there,
we
but
don't, but we'd sure like you to take a look. We think we could help you.
absolutely you can. It's wonderful. Absolutely stellar product. It's an extremely valuable tool. for an originator. So in many ways. So appreciate that. Well, thank you, Barry, for joining me. I really appreciate that. We'll catch up with you again soon, I hope.
The industry appreciates you, brother.
Oh,
You
well, you're
know
very
that, right?
kind. You're very kind. Thank you for saying that. All right, brother. Thank you so much. And to the rest of you guys, thanks for joining us here. Catch up with us next time. Catch you later. Bye-bye. Adios.